Okay, we're live now.
Jerry, we ready to go, you think? All right, with that, I will call this regular meeting of the Kentucky Retirement System Investment Committee to order. And we understand there is no legal opening statement. So,
No, there's no public comment. There was the legal opening
I'm
statement.
sorry. Let me ask, no public comment. I skipped ahead. Vicky, would you do the legal opening statement for us?
Yes, sir. For the record, I want to note that this is the meeting of the Investment Committee of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. And now I understand there's no public comment. And with that, we'll move forward to the approval of minutes of the May 15th meeting.
Would you like for me to do the roll call, Mr. Lane?
Oh, I keep skipping things. I just try to move this thing ahead. Yes, please, Sherry, do the roll call.
Sure. For roll call, we have Mr. Lane,
Here.
Ms. Bova,
Here.
Mr. Atkins,
Here.
Ms. Thompson. Thank you.
So we do have a quorum. The next item is the approval of minutes of the May 15th meeting. Any changes or corrections or additions anyone has for that?
Move approval.
Thank you. We have a motion to approve, and could I get a second?
Second.
We have a second, and we don't need a roll call vote on that. So the minutes are approved as included in the board books. So the next item is, I believe, we're going to change the order. Is that correct, Stephen? You want to do that?
We can
go at this point.
No, we can jump into the investment budget first if you'd like to.
All right,
Stick to
the
it.
investment budget.
Mr. Chair, just so we don't run into trouble with the minutes, you may want to call for a vote. I know we don't need a roll call vote, but we do need a voice vote to approve them.
Oh, good point.
Thank you, Mr. Atkins. Yes, there was a motion and a second, but not a vote.
Okay, we will ask for approval of the minutes. All those in favor say aye.
Aye.
Aye. No, any nays? Hearing none, the minutes are approved as stated or as issued. Sorry, thank you. Stephen, do you want to move on to the investment budget?
Sure. If you could move to page 99, please. Thank you. As you know, that fiscal 2023 was the first year we developed and started presenting an investment budget. So this continues to be a work in progress. For fiscal year 2023, we came in under budget by 2.4 million, spending a total of just under 6.2 million across all three of our categories. The investment budget for fiscal 2024 was recently approved, excuse me, and is included in the report. You may note the biggest changes in the budget for fiscal 2024 were the increase in legal expenses, which were increased by a little over 3 million, and a decrease of 1.4 million for custodial services. The increase in the budget for legal expenses was requested due to the anticipated movement and activity related to ongoing litigation. And we reduced the budget for custodial services after determination was made that we had budgeted an increase from historical averages because we were considering utilizing some additional services that BNY provides, and the determination was made that we would not pursue utilizing those services. So we reduced the amount budgeted for next fiscal year down to what our historical averages are. BNY custodial will have some fluctuation. Obviously, it's an AUM based, transaction based, and account based charges. So we will, as our AUM changes, as we open up new accounts, as we increase or decrease the number of transactions in those accounts, you will see some fluctuations in those charges. But we relied on what we've seen over the last 5 years as historical averages to budget for 2024. The net result for the 2024 budget was in total increase of 1.7 million for the fiscal year. Were there any questions on fiscal 2023 or what we had budgeted for fiscal 24? If not, Sherry, you can move to page 102, please. So for investment fees and expenses for the fiscal year, we're down 62.7 million at the KPPA pension portfolio level and 32.1 million at the KPPA insurance portfolio level. And these declines were the result of steep drops in the performance fees in private equity and real estate asset classes, as both of those asset classes posted negative performance for the fiscal year. Excuse me, the performance for fees for specialty credit also declined, but to a much smaller magnitude. You may also note that the specialty credit miscellaneous fees, that's kind of the catch-all category that's not management fees or performance-based fees, saw a fairly significant increase. And that is really the result of a number of those mandates employ credit facilities as part of their strategy. And as we saw a significant rise in short-term rates, the cost of those facilities went up accordingly. We would anticipate that as long as rates remain elevated, there'll be judicious use of those credit facilities, and the rationalization of the facility is based upon what the expected yield on the assets that are available. So right now it's a bit of an arb. They're able to achieve, well in excess of what the credit facilities are costing the funds.
So Steve,
Yes.
to make sense of this, do we have any consultancy that reviews this information to tell us where we stand against benchmarks? Or is there any kind of analysis that you can provide us as to whether or not there are anomalies in this, or we're paying too much? In exercising my due diligence over this, I see a lot of numbers, but I don't know how to calculate them to make any sense.
No, that's an excellent point, and that's the next iteration of this process. Obviously, what we're trying to provide here is a historical. First swipe was taking a historical context, what we paid. Obviously, it's most fees are on an annualized basis point arrangement, so you can see as AUM changes, you'll see a change, but the next step is part of the CEM benchmarking study, as well as we work with Wilshire, and that's really on a mandate by mandate basis. So when we look at a large cap public equity mandate actively managed, our fee basis we compare to what's available for peers. Part of the difficulty in that exercise, and Wilshire can weigh in as well, is what we'll also often see is you see published rack rates. So, our goal obviously is to, because of our scale and our ability to negotiate fees with managers and relationships that we have, we want to be well inside of what the published rack rates are. But what is that? That really is it provides a little less information, and I think it is useful. So what we try to do is delve deeper into what are actual pensions of our size with our size mandates able to achieve on a fee basis within specific asset classes. And that's information that we hope to be able to provide this year. We do that on an ongoing basis, looking at what we pay, but we hope to be able to put forward something that obviously provides that information to you and is useful for the fiduciary perspective.
Steve, if I could,
Yes.
David, we are subscribed to the December 31st, 2023 CEM study, and it will have not only actual fees and fees per and comparative fees, not rack rates, but also expenses. So we're going to get a pretty good look, and we're going to intend to do it every other year. That's the current intention.
So do we have the ability, if a reporter were to call us today and to say, are you paying too much in fees for the returns you receive? Do we have the ability with confidence to answer that question?
We have the number and we have some perspective, but we don't have, do I have a complete confidence? No.
Those are related and intertwined issues. We are comfortable saying that the fee rate that we are paying for our mandates in specific asset classes are very good on a pure comparison basis. And then performance is the next layer. Now we evaluate that separately. We evaluate absolute performance, net performance of a fund, or a specific mandate or manager. So are we paying? We think we're paying very good on a fee basis level, and we review and evaluate our managers on an ongoing basis as to their performance. And that performance is, again, when we look at, are we paying too much in performance fees? Well, we're paying too much for performance fees if we're achieving very good performance. And that tends to be that high class problem, but that's something that we review on an ongoing basis.
Yeah, so the performance.
I would say that we have as much as the typical fund has. We're going to have more in the future.
Great, and I want to commend you for engaging in this exercise. It's very, very helpful, and this is great information, particularly with the historical perspective. I'm interested in whether there are any rules of thumb with regards to, as a percentage of your total fees, does it make sense to have any kind of ratios with regards to what your performance fees should be compared to your fixed fees, in that, you don't want to just have your net fee number be the benchmark, because that means your performance wasn't great. Actually, when you're paying more in performance fees, it's all proportional, but it means your returns are greater. So I just don't know, like, with all of those moving parts, is there any rules of thumb that provide sort of the layperson with an opportunity to judge, was our proportionality of performance versus fixed where it should be, or is that a question that just doesn't make sense given the inputs?
What we tend to view is we look at the base management fee first and foremost. Because exactly to your point, the performance fee tends to be a very negotiated fee. It used, the old 2 and 20 is not nearly as prevalent as it was, and that's going to vary across asset classes as well. For those asset classes that have performance or carry interest fees, we negotiate hard both on the base and on the performance and what the participation is for those. I think the most informative is going to be what is our base rates, our base rates across asset classes on a comparison basis to peers. I think that tends to be the most informative. And then the next layer is the performance. We look at that when we evaluate, when we're when we're looking at new mandates, what's the balance we want? Is it, again, we look at it and all in the expected performance that we're going to get out of a mandate and the fees that we pay. And if the expected performance warrants that higher fee, and it's still on a net basis where it's a benefit to the plans relative to a mandate that might not have performance fees, I think that's where those decisions are made. So is it a baseline of how much proportionality between performance and base fees? That's not something that we necessarily consider. I think we're cognizant of that, and we're managing. The other layers to that tend to be more illiquid investments or the illiquid categorization, and we look at a liquidity profile. And in fact, Wilshire may talk about that some, or we'll talk about it later in the asset allocation and asset liability work that we're doing, and how much liquidity we have in the portfolio. So that tends to be part of that exercise.
It seems like one of those things that I'm hungry for AI to be able to take our specific data and compare it to all of the data points out there to let us know where we stand, and to determine whether our negotiation on a human level should be calibrated to all of the data points. And so it's a little overwhelming. But Mr. Chair, I appreciate you letting me go down that rabbit hole. And I really do commend everyone for finally getting to this place where this kind of information is being accumulated, reported, and an opportunity for the next layers to be applied with the success of this layer. So thanks for doing this.
And as we continue to build out the data sets, I mean, I think that's exactly right. We'll be able to do more analysis and provide more, what I hope is useful information to trustees, right? looking at a bunch of numbers on a page really doesn't necessarily provide a great deal of information that's useful to you. So as we provide more, we hope to actually be able to provide better information as well.
I think
And I
it
think
would be
Dave
helpful.
Eager,
Sorry.
go ahead, I'm sorry.
If on this page, if we just look at the bottom line, it's consistently 1% total investment management fees. At the, the bottom blue line, management fees over market value, it's consistently 1%. So that's interesting to me, but also, well, I think what would be more helpful, because these dollars are a lot, is a percentage basis. Because if I come from my industry standard, I'm not going to pay more than 1% for someone to manage some assets for me. But here we are, now there's private equity involved, I get that. But here we are. So I guess from my perspective, it would be good to have a percentage basis at the end of the day that included investment management, the expenses we just went over, which were the investment budget, I guess would be in addition to this. And then whatever the additional expense is, if we could somehow get it into a percent and then try to lower the percent consistently, that seems to me like what our objective should be.
Steve, Steve, would you consider having two numbers? One is the traditional management fee, which I think you're going to find out is like 17 basis points or 18. I think that's kind of what Ramsey may be thinking about, from the carried interest, which is going to be a big number, 150 basis points, or it could be small depending on the markets. But the traditional management fee and off of a fee schedule, I think it's going to show up to be about 17 or 18 basis points, which is very well within the range of what people.
So why can't you use these numbers?
Well, they just have to be separated. You just have to separate the performance of carried interest.
Yeah, and I think that's something we certainly can do. And again, I think the focus there is on that line item that's really the investment advisory fees across asset classes, and we can get some granularity, some further granularity into, say, the public equities. There's going to be different. I think taking it's good information to have what the annualized basis point charge is for the investment advisory fees for all of the public equity portfolio. But I'd also like to provide, again, part of the benchmarking is additional granularity in our US versus non-US, large cap, small cap, active, passive. I think that hopefully that's the information you want to see, and I think you would find useful. And that's the one where we have that the most focus from a negotiating perspective on. That's the one that we really have more control over, and that's the one I think we spend most of our time in focusing and trying to keep as low as possible. So providing that information, that'll be a takeaway for me from this, is that as this process and the reporting on this evolves, providing that information. So the next iteration of this, I'll look to break out, certainly on the investment advisor. We can do it across all of these different fees. I think there's some caution with what gets included in the miscellaneous fees and expenses. This came out of a desire to be as transparent as possible. Some of those are certainly not, as I mentioned on the specialty credit. Those charges are not fees that are paid to managers. Those charges are part of the expenses of running a specific mandate or strategy. And I think there is a distinction there. Some strategies are more expensive to run than other strategies, depending on the services that are needed or required to run that strategy. But the takeaway here will be, we'll start adding something that is an annualized basis point charge that gives you an idea of what the weighted average is across asset classes, with maybe some additional granularity in the sub asset classes.
Steve, why don't we go back and do that for June 30th, 2023, so you have the whole year? What you intend to do, formatting going forward, do it for June of 23.
Okay, we'll have that as a takeaway.
And Joe's ready to speak, I think.
Yeah, Joe, do you have something to add?
I couldn't get in there. There was so much good conversation going, but Ms. Bova and your point and Mr. Eager's point, like public equity, for instance, there's no performance fee in there. So if you do the easy math, it shows that total part of the portfolio cost us about 17.5 basis points to run. So that's well within the 1% that we were speaking of earlier. but yeah, that's just a matter of doing some math and adding a column in there for you all, so.
Is it strange to anyone else that it's consistently 1% over the past 3 years exactly?
It's not, I think if you actually do the basis point calculation, you'll find it's a little over 1% for 2022, for example, but it's probably about 65 basis points for 2023. And that's driven by private equity, which swings widely.
Right. Private equity, performance fees from 22 to 23 were significantly different, so.
And one of the
Yeah.
problems in the industry, and the CEM will, I think, go down the road to helping us here is, and Dave Atkinson's point is the asset mix for public funds and large funds in general, particularly endowments at one end, varies greatly. And so it is truly an apples to sausage comparison in those bases. The public funds like Oregon and Washington have heavy hedge fund and private equity investments. And so their fees in an average decent year are going to look really high because of that asset allocation. So it's very desirable, as Dave pointed out, and Ramsey, you did as well, to know this. It's not bad information at all at any point, but it can be a little bit misleading. And so the CEM study, I think, will help bring it to a little better understanding of it.
Yeah, that's a great point. You also have data integrity and quality issues in that not all public plans report fees in the same level of transparency or degree that we might. But Ms. Bova, to your point, I think if we look at, say, the core fixed income, the consistency of the core fixed income fees, the assets, the total AUM has not changed materially here over the course of 21, 22, and 23, and the fees are relatively consistent. You'll see, as Joe mentioned, the largest variance is going to be on those performance fees, which tend to be large in periods of good performance. So 21, 22 for private equity, 48.5 million, almost 48 million, and then actually a negative in 2023 is the asset class had negative performance.
Well, it's a very good discussion. If there's, and we I think brought out some good points and a couple of things that are going to be coming down the road. One, the CEM study, and secondly, Steve's going to respond, I think, Ramsey, to your a better breakdown to give a little better understanding there. So thank everyone for that.
All right, yeah, and is there additional ideas? I mean, this is a great conversation, and our goal is to provide information that's useful and helps you fulfill the fiduciary duty that you have. So as you have other ideas, please feel free to reach out to any investment staff, and we can work on getting the information that you need.
I just have one more question while we're on here.
Sure.
And we don't have to answer it now, but like the total 16 million under 2023, I mean 16 billion, excuse me. That's total market value as of June 30, 2023. And I hate to skip forward, but when we move forward to the pension and insurance, does this number here include more than just the KRS pension and insurance?
So that is the total KPPA.
So this is CERS also?
This is all, yes, this is the total asset class for KPPA pension and KPPA insurance.
Okay, it's a little confusing for me when we move to the next pages, and I hate to jump ahead, I'm sorry, because it looks like all of those numbers we're about to look at should add up to 16 billion, and it doesn't. And I think what you're saying is because we're not looking at CERS.
Yeah, the total fees at an asset class basis are presented at the KPPA level,
Okay.
and then we do a breakdown by plan level.
Got it. Thank you.
Sure. All right, well, appreciate that discussion. Sherry, if you could move to page 6, please. I'm going to have Wilshire provide a review of markets, their performance, economic conditions for the quarter, and an update on their current views. And as we'll get into, and as I briefly mentioned, we're also engaged working hard on revising the asset allocations in the IPS, as well as doing an asset liability study, giving the material market changes that have occurred since the last asset allocation work was done. So we're excited to bring that to you, and I'll have more on that in a little bit. But Wilshire?
Great. Thanks, Steve. And Craig and Chris and I are all on today. Craig and I will go through various slides in this first section. Sherry, if we could go forward, please, to the next slide 7. And for all of you, any of you who follow what's going on in the markets, it's been some pretty strong dynamics on both the upside and the downside just throughout this year. We know what we dealt with in 2022 calendar year. We'll focus largely in this report on your fiscal year, relevant time period, having just ended June 30. But interesting to just compare, if you look at this column titled 2022, that's what we were dealing with last year, where we had correlation, strong positive correlation between stocks and bonds, growth assets and defensive assets, because we had growth assets selling off, and we had rates rising so strongly that we had negative returns to bonds. So in 2022, in the middle of that page, we dealt with this everywhere. Core bonds down 13%, developed market equities were down 14%, US equities were down 19%. Then if you just connect that to the column right after it, 2023 year to date, you'll see a lot of the opposite happening. And then if we go over and just focus on that annualized 1 year as of 6/23, this is the fiscal year period that just ended for you. And right on the top of that column are the equity markets developed, or those countries outside of the United States, and then the US equity market up 19%. So if you think about the way we always talk about your asset allocation, and Steve talks about it, and we've got a lot of work coming up on this, growth assets are the equities, things like the high yield markets, the credit assets, the private equity, et cetera. It has been a growth asset story since the turn of last year and then into this year. That said, we continue to have a strong market rally. We're up about 18%, 18.5% in the US equity market year to date through yesterday. But it is, as you know, if you follow it, big up days and big down days. We have a lot happening. So much of this is driven by how the market is anticipating that everything will land with the Fed's efforts to slow down inflation and slow down growth. And how well do they come out of this? You hear all the talk. Will it be a soft landing? Will it be a hard landing? Will we have a recession? Et cetera. Forecasters everywhere. Some are forecasting recession later this year. Some are forecasting it out into next year. It's unknown. It's all about how well this all lands. But we continue to have consumers spending money in the US, and that drives about 70% of our GDP, our economic growth. That continues to happen, and we continue to have basically a strong labor market. We'll see, Craig will show us some slides with some cooling to that as we go. But so that's where we are on your fiscal year. Equity markets up strong, 19%. If we go on to slide 8, what does that mean for our forward-looking capital market assumptions? We don't need to spend much time here because we'll be back to this in future meetings with work we're doing that Steve had referenced earlier. But you can look at a couple of things. We have had so much strong return in the equity markets that now these are our June 30 capital market assumptions looking forward for 10 years. So it's not a short-term horizon, it's 10 years. But the amount of volatility that we've had in the real-time markets in recent times certainly drives where are things positioned at June 30, and then how do we look forward. And so the first column you see on here are US stocks, US equity markets. Right now, after this strength that we've had, we have a forward-looking 10-year return that is at 5.5%. That's the compounded return over 10 years. That is lower than other equity markets. That's due to valuation differences, where so much of this rally has been in the magnificent 7 names here in the US in the top of the capital market stack. And we've just rallied in the US relative to everywhere else in the world. And so looking forward, valuations are such that we have slightly higher expected returns for the non-US markets. You can see in developed and emerging stock in the 6+% range. But also very important, what we struggled with for so long were interest rates near zero. So the benefit of the higher rates that we face when we look forward and we do asset allocation work, we have a core bond assumption that is at 4.85%. That's just a huge improvement relative to 2 years ago. What is also happening is we have, on a forward-looking basis, very little equity risk premium expected. If you just look narrowly at US stocks and US bonds, you're 5.5 on US stocks, 485 on US core bonds. That's about a 70 basis point risk premium for equity markets in the US. That is historically extremely tight. So as we look forward and do asset allocation work, that all gets reflected in the work that we do and how we model your current policy and looking at other policies, et cetera. So more to come on that. We'll be back with a lot more of that as we go through some future meetings. Then I'll just highlight a couple of things on slide 9 in the US equity market. Here, as you look through the quarterly and the year-to-date chart on the top left of that, the broad market, the FT Wilshire 5000 up 8.4% for the quarter. And then where did a lot of that come from? If you look over to that top right chart, you'll see essentially everything but energy and utilities positive for the quarter. Technology, information, IT continues to be the biggest driver of this. Those two top bars on the right-hand side chart, 16.8% for the quarter, 41.6 on the year-to-date measure. Those are the strongest drivers. That's IT. That's where a lot of these big names are at the top of the market. So that is causing things like the chart right below it, where we look at the differential between growth stocks and value stocks. So much of the market run-up occurred in the growth stock area. Those towards the right side of that chart, when you see some of the bars going negative a few quarters ago, we had value stocks recovering, outperforming growth, but it was temporary. Every time this market rallies, it tends to drive these growth-oriented stocks higher again. So we see the last 2 quarters have been growth over value. Just like on the bottom left of that, those last 2 quarters have been large cap over small cap. So that just continues to play out. When we look again back to the top left chart, the 1-year column, that's your fiscal year, 19% for the US equity market. Big differential on that 1-year trailing 1 year, we're 19.6 for large cap versus 13.3 for small cap. Again, that's those big names driving at the top, and you just see that play out in the rest of this column as you go down. So we'll continue to watch that, but those are the things that would be affecting and driving performance for the fund over this past year. And then on the next slide, just a bit more on the non-US markets. Similar but more muted numbers here. The 1-year numbers for the ACWI ex-US, top of the next page 10, Sherry. Thanks. The 1-year 13.3% for the ACWI ex-US. This is all country world index minus the US. So these are both developed and emerging markets, up 13.3%. And then you see the breakdown, emerging markets struggling in this shorter period with significant declines in China versus other countries. That continues to be a narrative of its own as China is struggling through this process. So non-US markets, again, strong from an overall perspective. In emerging and developed markets, quite a differential between those. And then we'll go to fixed income on the next slide, 11. And here we see in the bottom right chart of slide 11, the Treasury yield curve. In the dark blue line at the top is the June 30 positioning of that yield curve. So significant issue with rates continues to be that we have an inverted yield curve. That inversion is certainly, mostly displayed in that short-term period, 0 to 5 years. So here we have the shortest rates higher, and then it begins to level off a bit between 10 and out to 30 years. But you can see how the yield curve this quarter is not a whole lot different than last quarter, just simply higher as rates went back up a bit this quarter, which led to negative bond returns for the quarter. So you can see those numbers up in the top of those charts. And then finally on page 12, just here to talk a little bit about high yield. And you can think about this as kind of a proxy as you start to move into that credit, high yield and specialty credit part of your portfolio, where these also are growth oriented assets. That said, not the same growth level as things like public and private equities, but 1-year returns to high yield bonds, just the Bloomberg High Yield Index were 9.1%. The S&P Levered Loan Index higher at 11.8%. And you can monitor in the chart below the spreads relative to treasuries, and that green line at the top is the CCC bonds, the lowest quality bonds. You can see those spreads and how they've come in, back out, and then dropping back down in a little bit right now, this trailing quarter. So a lot of volatility in these markets. In the short term, we've picked up a lot of return that has paid us back from last year. Forward looking, lower expected U.S. equity returns, very positive and value add expected fixed income returns from rates being higher, but volatility remains. So much of what we're seeing day to day in the market is just how the market is reacting to where it thinks the Fed will land and where all of this economy will land, which no one knows with certainty at this point. So we'll continue to monitor this and address it more as we go. So if there are any questions about those slides, if not, we'll go over to Craig and he's going to touch on some of the economic data points.
All right, hearing none. Thanks, David. I'll start on 13 and just make a few quick comments on the first few pages here. And to echo some of the points that were already made, we don't know what's going to happen, but it seems like we've been anticipating, or the market has been anticipating, a recession for quite some time here. Just looking at the shape of the yield curve and the inversion there, and all the talk of hard versus soft landing. It remains to be seen how this Fed action plays out and how the economy recovers. One of the strong points that we've seen throughout the last couple of years has been the labor market. So on this page 13, we see on the top the monthly change in non-farm payrolls consistent, although you can see by the trend somewhat slowing growth in payrolls, indicating a strong labor market. We've heard the stories about the number of openings per job seeker, low unemployment rate at multi-decade lows. The lower chart shows the monthly change relative to what the median expectation was. So not only have these job numbers come in consistently strong, but they've also come in stronger than expectations. But as we move to the next page, we see, on 14, and then we'll get to another page that shows another sign of potential slowing in the labor market. Here we see those non-farm payrolls in the red line. So those monthly changes we saw on the previous page lead to this nice, smooth, consistent growth that we've seen in that red line, which is the total non-farm payrolls. But then in blue, we see the average weekly hours worked, and the arrow shows the trend line declining here for the last couple of years. So what this potentially means is employers are wary of letting people go. Fear that if we have a soft landing and the economy doesn't contract, it might be hard to bring workers back in, or it might be expensive to do so. So where they have the ability to do so, one of the ways they can cut back in anticipation of a slowdown is cutting hours. So we can see on the bottom chart, total weekly hours, which obviously is a combination of the number of people working in those average hours, might have or might be plateauing here. It seems to have really steadied out in the last 6 months, especially. So that's a potential sign of a little bit of weakness hitting the labor market. On the next page, we see another sign. A potential slowing is an increase in jobless claims. So these are initial claims. This is a weekly data point. And then the trend line in black there is a monthly rolling average. The last two observations here, we see actually an improvement in this data point. So dropping claims, so kind of bucks the recent trend, but the trend going back about a year has been slowly rising weekly claims. So some weakness potentially creeping into the labor market here in recent times, which would be a sign of businesses maybe becoming more cautious. As we move to page 16, we go from the hard data points to some of the survey information, which is a bit more forward-looking because it's leading indicators and expectations. So on the top, something we usually show in our market background pages, manufacturing and services PMIs. That 50 line across the middle of that top chart is meant to indicate the delineation between expansion and contraction. So we can see that services have come down close to 50, but have generally stayed above, well, whereas manufacturing has slipped below that 50 level, which would indicate contraction. And we see here the shaded regions going back to indicate previous recessions. And then the most recent section is shaded too, even though we're not technically in recession, but we've got 2000, 2001, the 1-2, the tech bubble burst, the global financial crisis in the middle there, and then COVID. And you can see that sharp drop off in these PMIs for all three of those previous recessions. And likewise in the lower chart, the Conference Board leading economic indicator, which is a combination of factors. You also see declines in that forward-looking measure, pretty well correlated with when we've gone into recessionary periods in the past. And on 17, as I mentioned at the beginning, maybe the strongest sign we've seen is this inversion in the yield curve. Here we have the 10-year minus 3-month and also the 10-year minus 2-year spreads. And you can see again, those previous recessions are shaded here where we briefly dropped below zero in each of those or went negative in each of those cases. Here we've gone steeply negative. So the bond market is certainly pricing in a cut in rates coming in the future, which would typically mean the Fed reacting to a recession. But I guess potentially there could still be a soft landing scenario where they're able to get inflation under control and slowly take their foot off the brake without completely coming to a stop. But this is a pretty strong signal and one that historically, traditionally pretty well correlates with the onset of a recession. And then one last point I want to make on the next two pages, starting with 18. So on the bottom here, we can see the top shows the break-even inflation, and then the top, and then the black line shows that step up in the Fed funds rate. So we can see about the end of the third quarter last year, those two lines cross where market 1-year expectations for inflation fell below the Fed funds rate. And the Fed has obviously continued to raise rates while forward-looking inflation expectations have been pretty much range bound in this 2 to 3% range for that period. Down below, what we see is the difference between those two. So the green section indicates accommodative policy and the red restrictive. So we've obviously gone from, as that red trend line shows, that arrow shows, we've gone from very accommodative to very restrictive relative to recent history. So while the Fed rate hikes have been unprecedented in how quickly they've been made, they have also not been in effect very long. And that's something we look at on page 19. And I'll finish up here. The Fed the Fed tools to try to control inflation as part of their dual mandate they have a couple of weaknesses. And one is that the magnitude of the impact that rate hikes are going to have in the economy is relatively unknown. It's not a very precise tool. And secondly, the delay and the timing that those impacts take to hit the real economy is also somewhat unknown. So what this page is showing here is that we've only had higher rates, this 5% rate here for 0 months. We've only just gotten to this 5% rate environment. There's only been 3 months with 4 3/4, 6 months with 4% rates, 9 months at 3%. So as time continues to go forward, even if the Fed stops raising rates from here, as long as they don't cut, we're going to see this wave come forward and forward and forward. And the amount of time that these higher rates have been in effect will also have a cooling effect on economic activity. One of the ways you can think about this is, with 5% rates, if a company hasn't had to refinance any of their debt in the last 9 months, they haven't had to deal with rates over 3%. If they have to refinance later this year, now they're looking at 5% rate. So the longer those higher rates stay in effect, the more impact we'll see on the economy. And it's still been, because of how quickly the Fed raised rates, it's still been a relatively short amount of time where companies and the real economy has had to deal with these higher rates. So there'll be a kind of a knock-on effect of the higher rates as they're in effect for longer periods of time. So we expect that to play its way out here as long as the Fed continues to be hold rates or even issue some slightly higher rates. It's going to take some time for their actions in the last year to really flow through to the real economy. So in the interest of time, and I think we've kind of hit most of these points, I'm going to skip the next few pages if there's no questions and just hand it over to Steve to talk about your portfolio.
Greg, I do have a question if I could, and I'm not on the investment committee, but two parts. What's your outlook for office real estate, and what are the implications for what that may be? That's number one. And number two, is there anything on the horizon that we should be alert to that might be, I don't want to say catastrophic, but significantly negative to our portfolio?
Sure, I'll actually hit the second question first. I think the main thing there is we try to keep a long-term focus, and that's where this asset liability or asset allocation study comes in. As mentioned before, our forward-looking expectations for particularly U.S. equities are pretty muted compared to history, and one of the factors we look at there is the equity risk premium. So the additional expected return you can get from stocks for the extra risk that they carry compared to fixed income, and that premium you're getting for equity risk is at the lowest levels since Wilshire's been projecting forward-looking returns 40 years ago. So the premium you get for holding stocks right now is severely depressed. And I think one of the main outcomes of looking at asset allocation will be that bonds finally look attractive again after a pretty extended period where, lower risk fixed income, so to speak, was not very attractive. You really only got attractive returns from fixed income by going with riskier, more growth oriented or more private structures. But something as simple as your core fixed income, which historically has served as the portfolio ballast, was not attractive from an optimization perspective, and now with higher rates, it has somewhat returned to its previous position of not just being there in case equities draw down, but also giving you decent income as you hold it. So we're not necessarily predicting any short-term catastrophic changes, but when we look over the long-term horizon where we think we have a better ability to kind of project what's going to happen than anything short-term, we think there might be some rebalancing of the portfolio away from growth-oriented assets that can help you maintain your expected return while reducing risk. So that's coming down the pike. And then as far as real estate goes, that's really going to be very strategy dependent and dependent on what your managers have. If I'm remembering correctly, your real estate exposure is already pretty limited in the office space, but even beyond that, depending on your manager and where that office, if there is much at all, is located, it really depends on the manager's ability to transition that potentially to something else, or kind of maintain those exposures in those markets that are holding up a little bit better. But I think you guys, your real estate, just from previous comments, and Steve can obviously talk to this in more detail. Your real estate is probably relatively pretty well positioned compared to some investors that have a much higher office allocation.
Yeah.
Yeah, I'll just add, Craig, I'll just add to that one. Oh, I'm sorry, Steve, go ahead.
No, I would say, as we will talk about, we've been cautious on real estate broadly. We have limited exposure on the commercial side and specifically in office, which has been the hardest hit. But most of the managers we talk to, Craig's exactly right. I think this is going to take time to play out, especially as their chart indicated. A lot of properties have not had to deal with elevated rates for an extended period, and they're still relying on loans at historically low rates. So as those roll over or refinanced, those are where the heartburn is being caused in the markets. But the opposite side of that is that the managers we talk to and the managers that we have in the portfolios, are really viewing this as potential opportunity. It's a little baby with the bathwater, and that other parts of the real estate market in sympathy have been hit. And I think there's some opportunity there because, certainly rents and capacity utilization are holding up well in other sectors of the market. And that's, the pricing pressure that you've seen there is a potential opportunity. But we've been cautious in deployment and historically cautious specifically in office and CMBS. And I think Craig's great point here, and I'll add to Dave's question as well, is, I think the biggest is uncertainty, and the risk I see is not a risk specifically for our portfolios and the approach to how we've managed them. But, we'll talk about this in performance in a little bit, is that, the shift, the narrative in the market is kind of moved. I think we were talking about transitory for a long time, and transitory led to the optimism that inflation would come down quickly and the Fed would soon be cutting rates. That's kind of shifted to resilience in the face of higher rates, the resilience of some of these growth sectors, which, that the health can be debated given the narrowness of the participation in some of these markets. But, the risk I see is that people become complacent, that maybe, overextend, get over their skis in some of the growth assets, given the recent performance, that we all have that bias. Some of these assets have held up well despite all the naysayers in the markets and prognosticators saying that, we're going to enter a recession or soon enter a recession, and people, the more they hear that and it doesn't occur, the more complacency that enters the market. And again, to Craig's point, that tends to be, we're talking short term there. Long term, that's where we're focused as investors. And that's where those longer term capital market assumptions come into play. But the risk I see in some plans and in portions of the market is that the complacency gets people to add additional risk in markets that, to some extent, we can have the argument whether we're priced to perfection is a term that gets thrown around a lot, or Goldilocks, and that people are starting to price in a very soft landing with a limited recession, if any recession at all, and continued growth in markets, which given the level of volatility, I think is a bit overly optimistic, at least in staff's view at the moment. So that's where I would caution. David, I know you had something as well.
Yeah, I think you've covered it well, Steve. And we within the sectors of real estate, it's all been said here. We also, are less constructive on office space, but you've covered that quite well.
I think it depends though. We have some office exposure here that's legacy and it's going to have issues. There's probably still more pain to come because I think nobody wants to take the marks that would probably be appropriate, because then they'd have to mark down more things. On the other side, we have a decent amount of Europe exposure that some predecessors have made. And over there, it's a different market in terms of people going back to the office, as well as the requirements for environmental guidelines. So developing that kind of space will command a premium versus some of the legacy assets that will be stranded over there. So we have some exposure to that. And as that gets built out, I think that will be a positive for us. But I think, like Craig said, it's definitely location dependent, market dependent, manager dependent. It's hard to paint a whole brush of it. But mostly we have relatively less exposure. And some of the exposure that we're gaining is going to be space that will be more modern and fitting with the market, and continue to be able to benefit from rent that is competitive rather than at a discount or sublease and things like that. But I think the other risk that Dave mentioned, I mean, if anyone looked at the Berkshire Hathaway call, there's a little bit of weakening in some of their areas that they highlighted, and so that's always something that I think we are obviously wary of, or pay attention to. I mean, yes, the consumer has been spending, but then some of the they have a lot of industrial exposure, and you can see some of the things that have occurred, and also some of the defensiveness they have. They have $150 billion of cash for a reason. So many reasons probably, but so that's something else I think we could add to.
Yeah, and to Anthony's point, I think we're comfortable with we have some exposures in the office space that are certainly gonna be potentially some more pain, but we're comfortable with where we do hold. And there are, as we've all seen, headlines very location dependent, and it's also property dependent. You've seen a big divergence. The old traditional A plus type properties are holding in a lot better than the lower quality properties. You see that, especially in cities like New York, where they're having a very hard time, or the concessions they're having to give on leasing properties, if they're even able to lease, kind of the second tier properties are very painful. Where the amenity properties, the properties that to Anthony's point, that maybe are green or LEED certified, they've tended to hold in a lot better. So again, I think that I view that as opportunity. We have confidence in the managers that we have in the space, in their ability to navigate that. That's why we've hired them. So we hope that actually creates an opportunity as we move forward. But again, I think broadly, that's it's an area, as you've seen, we'll see in our allocations, that's an area we've been cautious with. And I think that's worked out well. There we'll deploy capital as we see opportunities, but we remain cautious there. We remain cautious of the overall market, I would say.
Yeah. But even within it, I mean, industrial, we have a good amount of industrial exposure, student housing exposure. Those areas are holding in very well. Rent growth continues there. But again, it's even specific within that. One of our managers sold some properties in Austin at flat or not a great return, because that market partially got overbuilt, or at least their properties weren't as competitive. And then they're developing other ones that are much more with the market and fully up to fully leasing and strong rent growth. So it is dependent, like Steve said, on a lot of very specific things. It's harder to do on a broad level.
Steve, I don't want to jump ahead, so please just defer this if that's the next phase of our briefing here. But given the infusion of cash that the legislature provided, and some of the caution with which we deployed that cash, does the strength of having those liquid assets, given the interest rates and what can be earned on just idle funds, has that positioned us well, or do we look back and think we should have been more aggressive in moving that into specific investments?
You hit the nail on the head, and that's actually if we turn to page 33, one of the comments I was going to make is that while performance, especially during the quarter, the final quarter of the fiscal year, was strong on an absolute basis, we modestly trailed our benchmarks. And my next comment is, in hindsight, the portfolios could have been positioned less conservatively, certainly over the last 2 quarters. And really, again, that comment, take it with the grain of salt, is the narrowness of what the participation was in the markets, right? A lot of performance came from a very narrow part of the market, but given the resilient performance in certain markets over the last 2 quarters, we could have been positioned less conservatively in some portfolios and been quicker to deploy some of that capital. I would say that where we're deficient from an allocation perspective are some of the markets where we're more cautious, and we did try to utilize proxy investments. So while we do have still, we worked down our cash exposure where we did receive those allocations. And to your point, it's it's a lot more comfortable position to maintain that liquidity. It gives us flexibility, in what we think is going to be an opportunistic market. And currently our liquidity program is yielding close to 5.5%. So the opportunity cost of doing so makes it a lot less painful to maintain that liquidity. But given the returns that Wilshire showed for various markets, performance would have benefited if we had been more aggressive in deploying some of that capital. Again, it would have been market, asset class and market dependent. If we put it in in real estate, it may not have added or would have detracted to performance. So there's a balance there. I think we stick to our knitting here. I think we stick to our investment views. We align those with the information that Wilshire provides and the views that staff has for specific asset classes. And we try to be opportunistic in how and when we deploy capital. It also has a timing issue, as we'll talk about, and when we get to asset allocation, and that the timing of committing capital, as we've talked about, especially in some of the private markets, we've committed. It has to be called, so in order to be put to work. So some of that cash balance that we'll see from an allocation perspective, that high cash balance, is where we've determined that a combination of asset classes, including cash, acts as a proxy, and it's also earmarked for committed capital that we anticipate being called, in some cases in the next couple of months. So I'll probably add some comments to that. I may duplicate some stuff, but so
Steve?
Yes.
This may be premature, and you and I haven't talked this out, but if you look at the range of returns for the year on there, it's from just under 7 for the most conservative to about 9.5. In my sense of just reading press clippings, is those numbers are going to be reasonably good compared to other public funds.
Yeah, I'll hit on that as well, but I'll go ahead. And so and Wilshire can add as well. I know their peer universe is we're still getting data coming in on the peer universe, and that's across different peer universes that we look at. But one of the interesting things for the fiscal year is that I think the dispersion among public plans is going to be wider in some cases than it has been traditionally, and part of that. We saw some very large plans with 6-handle returns for the fiscal year, some cases below 6.5%. Some of that is dependent on, as we've talked about, how much allocation to alternative assets, those plans. Some plans, have gone a lot heavier in investing and allocating capital to those asset classes, and those asset classes did not perform as well for the entirety of the fiscal year. The dispersion within asset classes is some of the data that Wilshire presented was pretty high for this fiscal year. It was not a well correlated market. We had pretty significant dispersion within asset classes and across asset classes, and I think that's you're gonna see on a pure plan level basis a wide range of performance. But I think on average, we'll probably be somewhere, it's a wide range, but that 6 to 8% for peers is probably pretty reasonable when it's all said and done. And I think given the risk profile of these funds, as well as some of the headwinds that we had, I think we're pretty happy with the performance for the year, for the fiscal year, given the amount of volatility, in the gyrations in the market and the amount of uncertainty and some of the obstacles we had with managing allocations. So I think we're pretty happy with that. Specifically the KRS and the SBRS pension portfolios returned 2.38 and 2.27 respectively, while their benchmark gained 2.67 in the last quarter of the fiscal year. The KRS hazardous pension gained 2.98 versus its benchmark return of 3.64. So obviously there we have different allocation targets, right? The KRS and the SBRS have the same allocation targets, the same benchmark, while the KRS hazardous pension and all of the insurance plans have the same allocation and the same allocation targets and therefore the same benchmark. So they tend to be higher risk in terms of what their allocations are. And performance played out that way. They had better performance for the year as really the second half of the fiscal year was much more of a risk-on environment. Performance for the insurance portfolios range from 285 to 307 versus their benchmark return of 364 for the quarter, which was again the same as the KRS hazardous pension. The portfolios underperformed their respective benchmarks during the quarter due to similar drivers of attribution. While the portfolios benefited from their underweight to real estate, which was one of the weakest performing asset classes during the quarter, the relative underperformance in the public equities and private equity portfolios, and the overweight to cash weight on performance. The underperformance, we've talked about this several times in the private equity portfolios. That's where for the quarter and for the fiscal year, we see dispersion even amongst plans that had similar allocation targets. And we've talked about this, written about this. Those private equity portfolios, our private equity portfolios, had a fair amount of dispersion in the performance for the quarter and the fiscal year, and a lot of that has been driven by what we call vintage and legacy issues. We'll remember back in time, a number of plans took a hiatus from funding and committing capital to new private equity investments when liquidity was a significant concern for those funds. So they didn't participate. They have, vintage and some legacy positions. Their portfolios, their private equity portfolios may look very different from some of our other private equity portfolios. And you tend to, what remains in some of those portfolios is not going to perform in a similar manner to more recent private equity commitments or to private equity markets in general. Some of those legacies, they tend to be assets or portfolio companies that continue to be worked through in realizing ultimately what the performance is going to be for those companies. So it's going to take some time to work out. They obviously weren't the low-hanging fruit, the ones that appreciated significantly and were turned over and realized very quickly. So as we look at the new IPS, we do the modeling work on the asset allocation, the asset liability work, and make the determinations about the liquidity profile that we want for those funds. And again, we're in a different place thanks to the work of the trustees, to Dave and to the team from a funding perspective. I don't think that concern is nearly what it was years ago when they took that funding hiatus. So the opportunity to maybe shift the liquidity profile of the funds a little bit and look at investing in what are considered the less liquid parts of the market, which often offer higher expected returns or yields. Those funds will be able to participate going forward. So I think you'll see that collapse over time, but it's going to take some time to deploy that capital and to get those plans, the portfolios to look more similar, specifically the private equity portfolios. For the fiscal year, all of the portfolios exceeded their assumed rate of return, which is great. The KRS pension portfolios gained 6.96%, and the SPRS pension portfolio gained 7.58% versus their benchmark, which returned 7.02%. The KRS hazardous pension portfolio returned 9.64%. The KRS insurance portfolio returned 9.87%. SPRS insurance portfolio returned 9.47%. And the KRS hazardous insurance portfolio returned 9.29%, all against their benchmark, which produced a return of 7.70%. In dollar terms, we ended the year not quite as strong from a performance perspective. We gave away some performance in those rising markets in the last two quarters, but still, relative outperformance for the fiscal year equated to approximately 10 million for the pension composite and 23 million for the insurance composite. I think that's it's a testament. It isn't necessarily what we're targeting. We were above assumed rates. We did outperform benchmark, but I think we struggled in the last two quarters to keep up with the benchmark, given the narrowness of those markets and some of that strong risk on sentiment. Outperformance during the fiscal year was driven by very strong performance in the public equity portfolios and the core fixed income portfolio, and the real return portfolios, as well as the underweight to real estate. These tailwinds were partially offset by underperformance in the specialty credit portfolio, as well as the cash overweight in some funds. We talked about the specialty credit, and Wilshire showed some some of the market performance for the year. Our specialty credit portfolio is a combination. The benchmark is public high yield bonds and loans. Our specialty credit portfolio is a little more diverse than that. We have some structured security mandates, or mandates that include elements of structured securities, and some of those structured securities obviously are going to have a real estate component to them. And as we saw, real estate was one of the markets that suffered during the fiscal year. So that underperformance in that portfolio allocation and specialty credit portfolio, it was not from true manager underperformance. It was more of an allocation within that specialty credit bucket and some of the exposures we had to what are off benchmark, given the overall allocation. So the fiscal year-to-date outperformance in public equities and core income in the core fixed income portfolios I wanted to highlight, they combined to provide between 75 and 100 basis points of outperformance for the year. So credit to Joe, both from a manager selection standpoint, as well as rebalancing amongst managers, which we did several times during the year, taking slight skews, both from a size, a growth, a cap perspective, as well as US, non-US. So the combination of public equities and core produced about 75 to 100 basis points across portfolios, which I think was fantastic. Better relative performance in our private equity mandates benefited most portfolios. As I mentioned, however, some of the portfolios, you'll see that big divergence was related to those legacy and vintage issues that we have. For staff, I think the most encouraging aspect of the performance for the fiscal year, which also speaks to the durability of the portfolios that have been constructed, is that this level of outperformance attributable specifically to managers and selections. If we look at for the fiscal year, we kind of break it at the highest level into what we call selection and allocation, right? Allocation differences relative to the benchmark. That was pretty flat across funds for the year. We had some the underweight to real estate. The benefit to that was offset by some of the overweights we had to proxy assets. So the majority of the outperformance across portfolios came from what we call that selection. So that's manager selection, and then how we allocate within that larger allocation. So if we tilt towards, as Joe would tilt towards non-US versus US, or large cap relative to small cap. And in fixed income, that was primarily that short duration profile that we maintained throughout the fiscal year in anticipation of rising rates. So those two things really benefited the portfolios. And so that level of outperformance was achieved, as Wilshire showed, in a period that encapsulated periods of both significant negative and significant positive performance. And the fact that the manager, the selection was able to achieve outperformance, combined outperformance or total outperformance in a period that included both significantly down and significantly up markets. I think that's a testament both to the process and to the durability of the portfolios that have been built. I'll stop there. I said a lot. If there's any questions, happy to take them. If not, we'll jump into 47, which again is one of my favorite Wilshire graphs. Appreciate them putting this together for us. And as we mentioned, performance data is still coming in for the peer universe. Typically fiscal year end for a lot of plans, there's a lag in reporting those numbers. As I mentioned, I think what will finally shake out is, for our peer universe, the different peer universes we look at, returns will be somewhere in the 6 to 8%. You'll obviously have a number of outliers that are much higher, and you'll have some that will fall at the lower end of that range. As expected, during periods of stronger market performance of portfolios with lower risk profiles and allocation targets, will tend to underperform this peer universe, as they did in the most recent one-year period, evident in these charts. And the performance tended to be in the bottom quartile. Portfolios with a higher risk profile continue to perform well compared to peers, with returns in the second quartile for the year. And over longer periods, all of the portfolios have produced strong performance relative to peers with returns in the top or the second quartile. That performance, again, I highlight that performance is achieved with what relative to peers is really a lower risk profile. And based on the Wilshire Peer Universe, the plans produce top decile performance over shorter periods and top or second quartile performance over long periods. And that's done at a much lower risk profile, is measured by their standard deviation metric in the middle. And all portfolios have produced top decile risk measures, a standard deviation over the 1, 3, and 5 year periods reported. The combination of these, so that's risk and performance, they combine to produce top decile Sharp ratios over time, and that really is an indication that the plans are consistently producing very strong risk-adjusted performance. This is the targets that we receive from the investment committees and the IPS kind of give us the bands with which we manage the assets, and the ability to take that risk profile and achieve the level of performance that we do. I think is a really strong testament to staff and the work that they do. And I think that Sharp ratio that we consistently show is a good indication of that. I'll pause there for questions. If not, we'll jump into 59
Steve.
Yes.
Let me make just a comment at looking at
Sure.
the whole of what we're doing here is asset liability, and of course the liability is the benefit payments. And Dave pointed out very correctly that we've been nice if we had been in a position to kick up the less liquid or risk-based assets a bit, but and Steve touched a little bit on this in the private equity area. We had a couple of years where we couldn't, and portions of our portfolio, we couldn't really add illiquid assets because we were almost on the verge of pay-go. Our income and our payments were negative for a couple of years, and then we broke through to positive, and now we're on a real good path to positive, but still not, in my belief, not in a position to be until we get to 40-50% funding to be one of those that's kind of market, if you will, or peer risk structured. So I think we've done a great job of dealing with what we were dealt, which was a virtual pay-go system. And now we can give credit to the legislature and the governors, two governors, and to the work the PPOB has done, partially steered by Dave Eager's efforts with them to educate them. So I think we're in a different position than we were several years ago. And looking at the 5-year returns in the 6s, that ain't too bad.
No, appreciate that, and I think achieving those levels of returns, given the risk profile and the risk that that we've undertaken, is pretty good. I think we're pretty happy with the performance. I'll briefly touch on page 59. We've kind of talked about allocation already, but at the end of the fiscal year, plans were broadly underweight real return, with smaller underweights to real estate and corresponding overweights to specialty credits and cash. We viewed the combination of those two asset classes as serving as the best proxy for the asset classes that the portfolios are underweight, given their combined risk and return profile. Specifically for the real return allocations, we continue to move closer towards target as the mandates that were approved earlier this year begin to deploy capital. We've recently met 2 capital calls totaling 20% of the commitment to Arctos, which is one of the new managers, and expect to fund another large capital call, as well as a sizable portion of the commitment to Maritime Partners in the September-October timeframe. So we continue to move forward. We appreciate our managers being prudent in deploying the capital. As we've seen and we talked about with some of these very, very large funds, they're very quick to deploy capital, kind of maybe not regardless of market conditions, but there is an urgency to deploy. They have very, very significant capital to deploy. And so they move very quickly with that. I think specifically with the managers we've selected for these mandates, I think they can they can be a little more tactical with their deployment. I know a number of they pass on a number of deals, and what they look at, it takes time to work through the deals and finally decide on which investments they're making. And we're happy to see that they've we've had several opportunities, and we will continue to have opportunities to deploy capital there. So that moves us towards target in the real return asset class. In the core fixed income, we talked about part of that driver of performance over the fiscal year was the short duration profile. We've recently started moving. We had a significant tranche that we moved from what is our short credit product, which really was, that was altering the duration profile of the funds, to a full core mandate. So we moved from one sub allocation into the full core mandate, which extended the duration profile of the portfolio. We expect to continue to shift assets out of the curve. Again, we started that short duration profile and specifically put it in what was a short credit product. It offered some amount of yield, and this was back in when we were kind of in a ZIRP world. Rates were very, very low, and as Craig mentioned, we didn't view the traditional core fixed income as really offering the ballast that it's intended to. So we shortened up our duration profile of that overall allocation in anticipation that rates would continue to rise. And we're certainly not calling a top in rates. I think, as Wilshire mentioned, there's a lot of uncertainty and discussion going on day-to-day market. We see the volatility in the MOVE index, which is indicative of the changing sentiment on a daily or weekly basis. We could see the Fed they're going to be data dependent. I think they're very committed. They've been clear in their communication, in their intent to essentially break the back of inflation and inflation expectations. Now they're having to deal with the stickier components of that inflation, so it may take some more time. So while we may not see the top, we think we're near the top of terminal rates, and then we think we stay there for an extended period of time. I think potentially the pricing in the market has moved out. If we think about it, we've earlier this year we were pricing cuts before the end of 2023. I think at one point it was close to 100 basis points of cuts were priced in the calendar 23. That's been pushed out, obviously. The resiliency of markets, growth, jobs market, and the stickiness of inflation is certainly caused the Fed to communicate that they are committed to sticking with this and will not be cutting rates too early. We continue to be cautious, as I mentioned, in deploying capital in markets where we feel valuations could potentially be stretched. Those parts of the market we think are more susceptible to downtrends if, as Wilshire mentioned, the tightening financial conditions, just now starting to bite. We're starting to see that. They mentioned corporate lenders or corporate borrowers having to pay, higher rates that they haven't in years. It's also, ultimately going to affect the consumer, which is the growth engine of the U.S. economy and a large part of the world economy. So as those higher rates start to play through, and financial conditions tighten, it is going to start to take a bite on growth. It hasn't yet, as our expectations maybe we're a little early to the game, but ultimately we think it's going to have its impact on both the economy and potentially on the follow through on markets. Page 96. Sorry, yes.
On this page, I guess I'm interested in focusing on this a little bit, in that asset allocation is one of those policy positions that the board takes and then assumes that the staff will function within those allocations. And if they're to mean anything, compliance with them should be something that the board is actively seeking to achieve, or we need to get rid of them, or have criteria by which we can deviate from them. And I know all of the caveats that you've mentioned here. I have no reason to disagree with them, and I believe that they're prudent and appropriate. But I also have to wonder, what is the opportunity cost, upside or downside, for not being in compliance? And I know looking in the rearview mirror is always difficult because you can't know, had those asset allocations been in compliance, what kind of performance could we have expected? But assuming that within each of the asset allocations that we had received the rates of return that we have received over the past year, if we'd moved them into compliance, would we have expected to have less of a return or more of a return?
So for the fiscal,
so-
sorry.
Yeah, so did being out of compliance cost us anything? Yeah, I guess is my bottom line.
Sure. For the fiscal year 2023, that's the allocation component of the attribution that we provide. And the attribution of essentially that assumes you're at target consistently, day to day at target and achieving the benchmark stated return, not necessarily the return of the portfolio, but assuming you're receiving the benchmark performance for that allocation. Across funds, that the total attributable to that allocation component was flat to minus 20 basis points. So it did, yes, the not being at target allocations across funds was a detriment to performance. Again, and anywhere from flat to down about 20 basis points.
So then that leads just to the question of understanding forecasts and all of that. But as a board, when could we expect reasonably to reach the allocation or have a recommendation to change the allocation to get into compliance?
Certainly. So combination there. One is the language that was added to the IPS regarding changes to what are considered the less liquid asset classes. We were provided a runway, a timing element, which I think we may want to revisit in the next iteration of the IPS. So it gives us a runway of I believe 12 months to achieve target. It also allows for the use of proxy investments in the interim. So what we view staff, the modeling work we do is if we can't immediately invest, or it takes time to commit capital and that capital to be called for a specific asset class, what is the best proxy? Typically public market or more liquid, I should say, not necessarily public, but what's the best proxy asset or combination of assets that's a proxy asset for that? Our goal ultimately is always to be, so you both provide a target and a range, right? And I view that as that's hard and fast. That's the guidance. If we're not in that range, we're out of compliance, right? I mean, again, with the caveat that you've given us a runway in order to achieve that. So that's our goal as a staff, and my goal is to certainly operate within those parameters that you provided in the IPS as far as asset allocation targets and ranges. I think on what we have been able to do is we're moving in that direction. With the commitments and specifically the real return was the largest, right? And that was a combination of the most recent IPS shifting both the target and the range materially higher than where it had been, as well as taking out what an asset that potentially we terminated a very large mandate that sat in that real return allocation that really was not a good fit. It was not an appropriate mandate for that allocation. So the combination of moving higher and taking out assets really caused, that immediately we were out of compliance outside the range. So it's taken us a lot of work to move in that direction. Real return is also one of the it's a very wide ranging asset class. Sometimes it's described as a bit of a catch-all. So there's a lot of different things. And I think our approach to managing that allocation has been that, we don't want lumpy or chunky exposures in that. I think that's one asset allocation where it really makes sense to employ some good diversification. So you saw with the managers, we had 3 mandates that were approved, and we're in the process of talking to additional mandates right now. We've made progress, but we could have gone a lot larger with those mandates. And probably gotten, at least as soon as capital's called within that target pretty quickly. But we didn't think that was the prudent thing to do. We thought that asset class warrants diversification in the exposures because it is so broad. You could put it all in commodities and say done. That's a real return asset class. Obviously hindsight, that wouldn't have necessarily been a great call either. But I think the other layer to this is, as we've looked at, and we've been looking at the last time our asset allocations were done, markets were materially different. Capital market assumptions were materially different. Expected returns were materially different. If we look at new, we've been looking at that since, with Wilshire, certainly we've looked at capital market assumptions since their December capital market assumptions. So over the first half of this year, those material changes are going to result in capital market assumptions are going to result in we're modeling that now, but some pretty significant changes to asset allocation targets. And I think what we don't want to do is we don't, especially in the less liquid or the private sector, make allocations that the new asset allocation is going to change and potentially reduce what our targets are, and now we've committed capital to an asset class that is difficult to alter very quickly. So I know that's probably not a great answer to your question, but our goal is to always be in compliance with the ranges and the targets that are provided by the investment committee and the board. I think we had a period after those allocations came out where, unfortunately, there was not a lot of movement in both sourcing, doing our due diligence, and committing capital to some of those asset classes. I do think we've made a lot of progress in the last 8 to 10 months in bringing on board new mandates and once capital is committed. So for the real estate, those funds that were furthest away from their targets and out of line, more importantly, with the exposures of the other funds, we committed additional capital to existing managers during the fourth quarter of the fiscal year. That ranged from anywhere from 75 basis points to 200 basis points of additional exposure. That's likely to get called September, October timeframe. So you'll see a move on the real estate allocation. So it's not always evident that we're making progress moving forward. I think if we look at numbers month to month, sometimes that obviously changes given denominator effects and how markets are doing. But we are moving forward, and I think a lot of progress. Well, the first 12 months, there was probably limited progress on that front. In the last 8 to 10 months, I think we've made pretty significant progress. And happy to, I think once we get through the work and we present the new recommendations for the IPS asset allocation targets and ranges, once we present that, I think we can, that'll be a good point to step back and say, this is the plan, how we would achieve those, how long it's going to take, what that means from a number of mandates perspective. Again, if we look at real return and when we have a target here, it might take 10 mandates, right? I mean, the number of mandates, given our desire to have diversification and exposures there, is going to dictate how many additional mandates we're going to need. So I think once we get to that point of assuming that the recommendation is approved for the new asset allocations, we'll be able to provide a timeline both in how long to commit the capital, potentially to deploy the capital, that'll be a window, and the number of mandates that we think will be needed in order to at least be within range, if not at target.
Steve, one thing that we might want to consider, as Dave brings up a good point here, we keep looking at this, and I know there's been a lot of work done. Maybe a third color, if you will, on here, or an addendum to this chart, is the pro forma. 12 months pro forma, the commitments that you have made, assuming they're taken down, which we don't even know that for sure, would put the real estate probably right at the bottom end of the range. Real return, who knows? But that might be another additional piece of information that would give the trustees some comfort.
No, that's a great suggestion. I think that's, we can certainly do that.
And Steve, for me, it's just a matter of, in exercising our fiduciary duty, it's concerning that we lost basis points because we weren't in range. But I'm also cognizant that, as you said, you could wave a magic wand and get into range tomorrow if you chose to do so. And there are opportunity costs for that kind of action as well. So I think what I have to balance is that our plan to get in range is a prudent plan compared to the risk of what losses may accrue because we aren't in range. I don't want a magical overnight strategy that costs us, but to the extent that this represents the policy of the board, being out of compliance is something we have to evaluate. What is the opportunity cost of both being out of compliance, and what are the potential opportunity costs of immediately getting into compliance that would justify the prudence and reasonableness of the strategy we are deploying to get into compliance. And I think you've covered all of that brilliantly, and I appreciate your both your articulated commitment and what the goals are, and I think a very prudent approach to getting there. But that strikes me as a core function of the board.
Absolutely.
In both setting the asset allocations, but then in making sure that there is a plan to get to them if they are to mean anything. So
absolutely. And what I'll also commit to is I think we try to be transparent with exactly to the point of what is our allocation either benefiting or costing us. It's always not necessarily clean, because we probably need some additional granularity that we're actually hoping this new system that I'll talk about that we brought online will provide a little our ability to provide additional information into that. But that will be upfront always, what the deviation from the targets on the asset allocation that you provided has either cost or benefit at times. But what that means, which I think is, like you've mentioned, is a very important part of your duty. So happy to provide that. And if there's additional suggestions or requests there, we can certainly work on that. Any additional questions there? I know that's a good one. So really, I wanted to jump into, lastly, in appreciating everyone's time, in high level investment office update, and just a couple of bullet points here. And what has been a very long process. We're happy to report that as of 6:30, we have finalized amendments with all of our managers, and all proxies for eligible securities are being voted in accordance with the KRS proxy voting policy. We are also meeting all of the statutory requirements for reporting proxies voted by the systems. So I think that's a great achievement. It took longer. Credit goes to Joe. Joe did a ton of hard work on that. And sometimes it's wrangling cats, but we were able to get all of those across the line by the deadline, and the reporting in place by the deadline as statutorily required. So I think that was great. As I briefly mentioned, so as of 6:30, for really the first time that I'm aware of, we're using an external system, our Solovis system, to perform independent performance calculations for reconciliation and verification of the performance that's calculated by BNY, which is our official books and records. That's what gets reported. That's what gets used to calculate the gainer. But we now have in place a system to do an independent performance calculation, verification, and reconciliation of those numbers. We also hope that the robustness of the data that system's capable of will allow us to do some a number of different things on the analytics front, on the performance front, on the portfolio management front, but that would include diving deeper into attribution, seeing what our drivers of attribution are in greater levels of detail. That's also some of the stuff that Wilshire provides as well, but this is kind of our we can run ad hoc, we can look at scenario analysis, we can look at what happens to portfolios. So that's something that I know we're excited about. The KPPA executive team is working with legislatures on language which would allow us to secure office space for the Office of Investments. I know Dave has had those several conversations. As everyone may be aware, we terminated the lease on the space here in Louisville earlier this year. We had been out of the space since December due to some water damage. Dave has graciously invited everyone to work out of his house if we need to, but I'm not sure we'll take him up on that. As I mentioned, we continue to evaluate a number of what we view as attractive opportunities across asset classes, obviously focused on areas where the portfolios are under allocated relative to their current asset allocation targets. I would hope that we can bring, again, depending on the outcome of the allocation work that we do with Wilshire, the recommendation, and if it were to be approved, I think there's some interesting opportunities that we've looked at that are unique, that really offer a really good use of capital in our risk budget. So we're excited to bring those should the opportunity present itself. We're in active discussions in an effort to fill open positions on the investment team. We added Brian Caldwell most recently, so we are building the team, but we do have open positions, and we hope to be able to move forward with filling some of those. It's been discussed ad nauseum here already, but we are working with Wilshire on updating the asset liability. I think for us, the biggest focus is to build the most efficient portfolios that align with both the capital market assumptions that we get from Wilshire, as well as that we utilize from other providers, that aligns with investment staff views as well. We will have views on markets that we want to incorporate into those, and some of that is iterative modeling that we do with Wilshire, and we certainly appreciate their efforts. The focus, again, as Pruitt mentioned, we have a focus on liquidity for a number of these funds. The liquidity profile the funding status has improved, the funding commitment has improved, but they still remain underfunded plans. So we will continue to have a liquidity focus. We want to build portfolios that are efficient, with higher probabilities of assuming their assumed rates of return, while reducing the overall risk levels, and we think that's achievable. So we're excited about the opportunity, to relook at what our asset allocation should be, what markets are affording us, and make those recommendations, which we hope to bring before the investment committee in the coming quarter. So with that's all I had. If there's additional questions, happy to answer them. Sorry.
Stuart, could I make a comment, please?
You sure may.
We look at a lot of performance and risk and everything else on a day-to-day basis. The investment staff interacts with HR, with legal, investment ops, accounting, finance, communications, and the executive staff. And I would just say we have found the investment staff to be extremely responsive and very cooperative, and it's just a good relationship. We appreciate it.
Thank you.
And Steve, I don't want it to pass without giving kudos to everyone who responsibly reacted to the legislature's requests for the proxy response and compliance. I think that shows us in a trusted relationship with people who are setting policy, and to be able to do it on time shows a responsiveness that I hope will not go unnoticed as we continue to work with them to make some of the very promising reforms and investments that have helped the system. So it may seem like a small thing, but I imagine it was a pretty big undertaking. And I'm just very pleased to hear that the efforts were made to deliver on time compliance with those requests, those edicts. So thanks.
Well, I think that's an important point, and it builds again into that big picture that the path that we are on to be better funded, in other words, a better asset liability profile in general. Part of the relationship with the legislature, part of it is due to a better relationship with the legislature. Now they, didn't get our housekeeping bill, which they are, I think Dave Eager would say is almost apologetic, and we'll get that done. But the funding is the critical thing, and the conversations at the PPOB, if you tune in on Facebook or go to the meetings, are generally, at least for our systems, are very positive. So is that, could we, I guess we're finished with the updates from Stephen, and there were some very important ones in there. Do we have the agenda? Do we have our last item on there? Sherry, I don't have my agenda up. Could we put it back up?
Sure.
I should have printed it out.
I believe the investment office update was the last.
Oh, the last one is our ever popular agenda item for which we have to vote for. Could I have a motion for adjournment?
So moved.
Second.
And any objections? Hearing none, this meeting is adjourned, and thank you for a very positive session here. And I covered a lot of ground. Thank you very much.
Thank you very much.